Hello and welcome to today's webinar on annual allowances. I'm Lisa Webster, Senior Technical Consultant here at AJ Bell. If you do want to ask any questions throughout the webinar, then please feel free. You should find a question box on the right-hand side of your screen. If you want to put any questions, anything you think of as we're going through, please do send those through to us, and then myself or one of my colleagues in the technical team, somebody will come back to you as soon as we can after the webinar is finished. So yeah, please do ask as we're going through. Okay, so the agenda then for today, going to be looking at, first of all, very basically, what is the annual allowance? I'm then going to turn to looking through the different allowances, how the different allowances interact and with each other and with carry forward, which will be applicable to some of them, but not all of them. We'll then look at calculating the annual allowance charge, and then finally what the options are for paying the annual allowance charge if that has arisen. So starting off with then, it's quite a basic thing really, what is the annual allowance? What does it actually mean? I think it's probably one of the terms or piece of legislation or whatever, pension terms that causes quite a lot of confusion as to what is actually meant. And when you actually look at the rules and even what it says in pensions tax and manual from HMRC, it's probably quite understandable really. The annual allowance, PTM, describes it as the maximum amount of pension savings an individual can make each year with the benefit of tax relief. So we know the annual allowance for an individual includes, well, the pension savings that are measured against the annual allowance includes any contributions made by the member personally, any employer contributions, plus any contributions made by somebody else, if there's any third-party contributions going in, and it against all the pension schemes, you know, if they're saving into or have benefit accrual in more than one scheme, it's everything combined. So it's a limit on the amount you see, that they can have for the benefit of tax relief. However, what it isn't is a restriction on the amount of tax relief given out when the pension savings are actually made. So that does sound a little contradictory, but it's important to note that in terms of you know, sort of the pension rules, what you're allowed to put in and how you claim pensions tax relief, the annual allowance actually has no impact at all. You can claim, which I'll come on to, you know, how much can you put into a pension? You can put in, you know, 100% of your salary for personal contributions. Your employer can put in, you know, any amount up to the wholly and exclusively rules, and they still get tax relief on it. The annual allowance doesn't stop the process of actually getting tax relief. But of course, there is an annual allowance charge if you put in contributions above the annual allowance, and there's a corresponding tax charge. So this is sort of where the sort of confusion arises. So in terms of what you can actually put into a pension scheme, as I touched on, for member contributions, it's the higher of your relevant UK earnings in £3,600. So for most people, that will be their UK earnings. So in theory, if somebody had a salary of £1 million a year, they could put £1 million contribution into their pension scheme, and they would get tax relief on all of it. Of course, there may be a corresponding annual allowance charge, which means people don't want to do that, but the rules do allow it, and they would go through the process of claiming tax relief. Similarly for employer contributions, the rules are a little bit different, but if it meets the wholly and exclusively rules, the employer can make a contribution and get tax relief on it. It may be that the individual has an annual allowance charge. I'm not going to go into more details about what I mean by wholly and exclusively or what counts as relevant UK earnings, etc., because I covered all that in the webinar that I did a couple of weeks ago on pension contributions, which some of you may have listened to. If anybody didn't and they are interested in that, I want to know a bit more about those details, it is available on the website. You can go back and listen to that one again. Just say I'm not going to go into so much time on that today. So that's how much you are allowed to put in. It's a lot, but of course, in reality, practical terms, what people want to know is how much they can actually put into their pension scheme without getting that annual allowance charge. So that's what we'll be looking at. So first of all then, what are the different annual allowances? Well, for a start, there's too many of them. It seems when it was first introduced, we just had the annual allowance, which is of course the standard annual allowance. But now we also have a tapered annual allowance, a money purchase annual allowance, the lesser known alternative annual allowance, which I'll explain what that is for some of you may not be familiar because it's not a common one, that one, not commonly used. And also we have carry forward, which interacts with those annual allowances as well. So we'll look at them in turn, and I'll start off with the standard annual allowance. So the annual allowance started as a concept back at A-Day, back in 2006, under pension simplification. And I'm told by my sources who worked for HMRC at the time of pension simplification and what was, sort of going on in the background, it was a bit of an afterthought really, because the lifetime allowance was designed, was going to be the main mechanism for controlling tax relief in pension schemes. That was always the intention. But sort of as it approached A-Day and sort of the legislation, the rules coming out, there were certain people that got a bit nervous about handing out unlimited tax relief on the way in. And so the concept of the annual allowance was born. Of course, at outset, back in 2006, it was what now seems like an exceedingly generous £215,000 a year. And we had the annual allowance. We knew what it was going to be for the next 5 years. It was set out in legislation at the time in the lead up to A-Day. Interestingly as well, it was also set in legislation that the annual allowance, like the lifetime allowance, wasn't going to be allowed to go down. We all know what happened there, but obviously legislation can be changed, as we know. So we had the first change then, the first big drop, say big change in policy, if you like, in 2011-12, when we saw the drop from then 255,000 down to £50,000, and that was when carry forward as a concept was introduced. I'm sure there's some of you that will remember the old carry forward and carry back from before 2006. Probably a little bit more confusion if you do remember it, because it's not the same thing, because that's carrying forward tax relief and not the allowances, so it is different. But I'll look at that in a bit more detail shortly. We then had another drop in 2014 down to the 40,000 standard annual allowance, which of course is what we still have today for most people, for the standard people that the standard annual allowance is applicable to. We did have a funny goings on in 2015-16 when PIPs, pension input periods, became aligned with the tax year. I don't think that is a good move. It makes things an awful lot simpler now when we have PIPs and tax years, or PIPs aligned to tax years in all pension schemes, make things much more straightforward in terms of calculating annual allowance usage, etc. Didn't always used to be the case. Now, obviously, going forward, it's aligned, so you don't have to worry about it. But there are times I know when you may have to look back retrospectively at what people have done, and you may still need to know about PIPs and try and remember the old rules and how things used to work. So, I mean, even prior to 2015-16, probably most pension schemes did have their pension input periods aligned with the tax year, but it didn't have to be the case. Some schemes may have run as standard as that your pension input period started on the date of your first contribution and then ran for 12 months. I know of schemes that did that. It was also possible to manipulate pension input periods. So it could be, you were allowed to have an input period, it had to be at least a day. You could shorten it, you couldn't lengthen it, but it couldn't be more than 1 year, and you could never have more than one pension input period ending in each tax year. So the pension input period simply is the period over which the amount of pension savings under an arrangement are measured. So if you could manipulate them, it meant, for example, if you could still do that now, if I opened a pension scheme today, I could put in £40,000 contribution, use my annual allowance. I could end the pension input period in the same day, open a new one tomorrow, put another £40,000 in tomorrow, and that would have run, I could run that pension input period into next tax year. So if it started today, it would run until May next year. And then because the input period ended in the following tax year, that would be using up next year's tax allowance. It would be measured against next year's annual allowance, not this year's. So it's a way you could use a couple of years' allowances, or 3 if you did it around tax year end. It's a way you could do it in a few days. You could get a lot of contributions in a short period of time. It's not possible anymore. But if you're looking back historically, for any contributions, trying to work out what people have done prior to 2015, then you do need to ask the question of the schemes involved. You know, when was the pension input period? Because that could affect actually when you made a contribution, which year it actually counted towards, because it didn't necessarily count against the annual allowance in the tax year the contribution was actually paid. So it was more complicated. So I do think it was a good thing for simplification for it all to be aligned, but of course we had some funny transitional rules in 2015-16 whilst the periods were aligned. So we have what's called we had a pre-alignment and post-alignment period. The announcement was made in the summer budget on the 8th of July 2015. So technically everybody had an £80,000 annual allowance for the pre-alignment period. So that was from the 6th of April 15 until the 15 to the 8th of July 15. And the reason they did that was that if people had made 2 contributions because they'd changed PIPs, pension input periods, and so they had 2 pension input periods, but they weren't penalised. So they had that pre-alignment. Post-alignment, technically there was a 0 annual allowance, but you were allowed to carry forward up to 40,000 unused allowance from the pre-alignment period to the post-alignment period. So for somebody who hadn't made any contributions in the pre-alignment period, it meant they still had a £40,000 annual allowance in practice, like normal. Okay, so that was 15-16. Since then, it has been straightforward in terms of the standard annual allowance, at least, and the fact it's just been £40,000 every year, and input periods are aligned with tax years now. So moving on to carry forward then. So we talked about that. This is introduced a few years ago now when we had the big drop in the annual allowance. Important thing to remember is it is the unused allowance, not the tax relief, that is carried forward. You can carry forward from the last 3 tax years, providing that the individual was a member of a UK registered pension scheme. So they don't have to be an active member, they don't have to have had the ability to make contributions, they can be a deferred member, they can be a pensioner member, as long as they are a member of some form of a UK registered pension scheme somewhere, then they will qualify, that they will have the ability to use carry forward of any unused allowance. If somebody was not a member of any pension scheme whatsoever, then you're starting from scratch. You can just use this year's allowance. You always have to use this year's allowance first, and then the oldest unused allowance. So use this year's first, then you go back 3 years, then 2 years, and then last year, to use it in that order. So a couple of examples now. First of all, here we've got Janet and John, who both have deferred pensions. Janet, first of all, then, she has not been making any contributions in the past 5 years, basically because she's been out of the country. She hasn't had any UK relevant earnings, so she wouldn't have had the ability to pay in up to the basic amount anyway. She has got £200,000 UK relevant earnings, however, in this tax year, because she's returned to the UK, obviously, and started earning some good money. Well, now she's back here. So the question is, what is the maximum personal contribution she can make, get tax relief on it, and not have an annual allowance charge? So the answer to that will be £160,000, because she's got a £40,000 annual allowance this year, and she's not used her annual allowance for the last 3 tax years as well. So she can combine all of those. She has £200,000 relevant earnings, so she has the earnings to support a maximum contribution of that size. Based on that income this year, she won't be tapered, which I'll come on and talk about in a minute, but no, so she could make a contribution of that size. The fact that, you know, she wasn't here the last 5 years and she wasn't in a position to make large contributions the last 3 years that she's carrying forward from is irrelevant. As long as she's got the earnings now and she was a pension scheme member, she can still make that contribution. We turn then to John, again, deferred pension only, and again, like Janet, he hasn't made any contributions in the last 5 years. But John has relatively modest earnings, £35,000 a year, but he's earned that consistently both this year and in previous 5 years. So, you know, he's been steadily earning that. Hasn't chosen to make any contributions. Now he's suddenly come into some money. He's inherited £200,000, and he wants to know what his maximum personal contribution is too. The maximum that John can put in is just the £35,000. Because it doesn't matter the fact he's got all this unused allowance, this carried forward from the previous few years that he would otherwise be eligible to use, because if he hasn't got the earnings to support it, you can still only ever put in up to 100% of your UK relevant earnings when it comes to personal contributions. You know, of your UK relevant earnings in the tax year concerned, the tax year that you're actually making the contributions. So carry forward is irrelevant for John if you don't have the earnings to support it. Another look at carry forward then, sort of some of the practical considerations and just sort of things to think about and what to watch out for. So I've said obviously you always use this year's annual allowance first, and then you can carry forward up to the 3 previous tax years. So if we look here, we've got somebody standard annual allowance got 40,000. They look at their contribution history over the last few years. They've made contributions for the last few years of around about the annual allowance. A couple of years they've been under, a couple of years they've been over. If you just look back at the 3 years previously, you may think, looking at this, that the £1,000 from 17-18, that unused allowance that we have there on that top line, you may think that that's been used up in the 2019-20. It's in last tax year when they actually put in contributions above the annual allowance, because they used their 40,000 from 19-20. They're obviously using some other carry forward. So you might think that £1,000 was used in 19-20, tax year 2019-20. And then you think, well, the other 3,000 needed to make up that 4,000, so they didn't have a charge, would have come from 18-19. So 3,000 of the 6,000 excess you have in 18-19 would have been used then, which means there's £2,000 left to cover the extra contribution they've put in this year, and they have £1,000 left, which they could still use next year. However, the problem with this is you don't actually know that for the 4,000 excess you have in 2019-20, you don't really know from this information what carry forward's been used here. You don't have enough information. So if we look at this again, what I've done here is I've added another tax year in. I've added 16-17, which we didn't have the information on in the last slide. The rest of the information is exactly the same. And really what this is just to point out that if you're trying to do your carry forward calculations and you're looking at the contributions people have made, and you know, some years they've got some unused allowance, some years they might have used a bit of carry forward. If there's any tax year in the previous 3 years where you're looking at your carry forwards available, where they've exceeded the annual allowance, you need to look back 3 years from that year to be able to see in what order and which carry forward has been used. So if I work through this one again, we can see now that in 16-17 the contribution made was only 38,000, so there was 2,000 of unused allowance. So we can actually see that 2,000, that unused allowance, that would have been mopped up in the 19-20 tax year last year, 2,000 of that. And then there would be the 1,000 from 17-18 that would have been used that year as well. But we would only have used up £1,000 from the 18-19 tax year, whereas previously it looked like we'd used 3,000 of that. We'd actually only used 1,000. We know that because there was some older carry forward that was used, which means for this year, we're using £2,000 of the carry forward available from 18-19, but there's still another £3,000 left, which we can use up in the next 2 tax years before it's gone. So it's just really the point that, say, if you look back over the last 3 tax years, if in any of those last 3 tax years, some carry forward has been used, somebody's exceeded the annual allowance in that tax year, you need to look back 3 years prior to that. Okay, moving on now to the tapered annual allowance, which I'm sure is everybody's favourite annual allowance. It's certainly the most complicated and the one where we get most queries on it. Now, the good news is in the March budget, they changed the limits on the tapered annual allowance. So the tapered annual allowance now is going to impact far fewer people, which is good news. However, it is still as complicated as it ever was. The mechanisms and what you need to know about calculating it, trying to work it out, that hasn't changed. It's just the limits have changed. And though many more of your clients, I'm sure that going forward won't be impacted by it than used to be, I'm sure for a lot of clients they will still have you'll still be working through the calculations from last year, maybe even the year before, but certainly from last year, working out, what their earnings are and trying to work out how much they are tapered by, what their annual allowance actually is, because people don't know their earnings till after the end of the tax year anyway, so I'm sure this is still quite relevant. So we have these thresholds when it comes to the tapered annual allowance, which for the previous 4 years since it was introduced in 2016, we had the first threshold set at £110,000, which from this year onwards is going to be £200,000. And the basic rule is if somebody's total income, which I'll come on to what I mean by that, total income in the tax year, in the last 4 years was under £110,000, or this tax year and going forward is under £200,000, happy days when it comes to the tapered annual allowance, you don't have to worry about it. For your clients that have income in the region of £110,000 and £115,000, somewhere in between that bracket, in the last 4 tax years, and then going forward between £200,000 and £240,000, then you do need to start thinking about the tapered annual allowance. It doesn't necessarily mean they are definitely caught. It means that depending on how the pension contributions are structured, who makes them, they may be caught. It may be that's where you can do some planning to get them below the thresholds, threshold income, and keep them out of it, and therefore they can make higher contributions in total, but how you balance that between personal and employer contributions becomes quite relevant. And then you have people whose income, say in the past 4 tax years, was over £150,000, and from this year onwards was over £240,000, and those people are going to be tapered. No matter what you do, what planning you do, they will be tapered. Obviously, there's measures you can take in terms of how contributions are structured, etc., which will impact by how big the taper is, but they will be impacted by it. So we have these definitions, which I've alluded to in the last slide, but we have it's adjusted income and threshold income. So it's where both those thresholds are met, that's when somebody is going to be tapered. So the previous 4 tax years, you needed to have had adjusted income above 150,000, the threshold income above 110. Going from this year onwards, it's going to be 240 and 200,000. Where both those thresholds are met, the tapered annual allowance works by reducing the annual allowance by £1 for every £2 of income above the adjusted income limits, which is the higher figure, subject to the minimum reduced annual allowance. And the minimum reduced annual allowance for the past 4 years has been £10,000. From this year onwards, it is £4,000. So the vast majority of people who were impacted by the taper will be better off from this year onwards, because the impact will be less, or they've been impacted by it in the past and they're not going to be going forward. but those people who are right at the top end, people who have income, sort of £300,000 plus, are actually going to be a bit worse off because their taper can be all the way down to 4,000, whereas previously it would only be down to 10,000. So how do we work out those threshold incomes? What do we mean by adjusted income, threshold income, and how do we work it out? So this chart sort of shows it. I'll talk through this, how you do the two calculations. The starting point for both adjusted income and threshold income is this net income at the top. I always find this slightly confusing. When I read net income, I find it very hard not to think of income net of tax, income tax, but that is not what it means. Net income for the starting point on your calculations are an individual's taxable income left after deducting any reliefs due under Section 24 of the Income Tax Act 2007. Basically, those reliefs are things to do with the trading reliefs, mainly for people that are self-employed, the vast majority of them. So if you think there are any reliefs that may be applicable to your client, do have a look through that. If you're in any doubt, the short answer really is to speak to their accountant, because their accountant should know what reliefs they're entitled to and how that's working. Sometimes we get asked, certainly when the rules first came out, we used to get asked a lot about gift aid, etc. Gift aid doesn't reduce your income for these purposes. Gifts of shares to charities is included. That's the only thing relating to charities. So the taxable income will include any of the following. So earnings from employment, self-employment, those pensions income, interest on savings, income from shares, dividend income, rental income, income received by an individual from a trust. So most forms of income, whether it is earned income or it is income from investments, will be included in your definition of net income. So going back to our chart here, so that's the starting point for both adjusted and threshold income. The difference between the two then. With adjusted income, you add in what I've called here employer facilitated contributions. By that I mean that anything under net pay is added back in, any salary sacrifice agreements are added back in, and of course any employer contributions are added in. So for most people, they will have their basic, whether it's reference pay with salary sacrifice or their earnings before the net pay arrangement has been put in place, will have their earnings and then they add in the employer contributions. The only deduction you have from your adjusted income, and it is quite a niche one, you're not going to get a lot of these, but you should be aware of it in case it happens, is if your client is the beneficiary of somebody who's died over the age of 75 and their pension benefits are therefore taxable and they choose to receive it as a lump sum rather than income. If they have that lump sum death benefit receipt chargeable to tax, then that can be deducted from their income for the adjusted income purposes. I say it's not one you're going to have lots of people where that's applicable to, but so just to be aware of that. Turning then to the threshold income. Threshold income, you have to add back in any salary exchange agreements, salary sacrifice agreements set up after 9th of July 2015, which is the date that the tapered annual allowance was allowed. So that's was introduced, sorry, was announced. That's just an anti-avoidance arrangement that you couldn't artificially reduce the level of your salary. Obviously, if it was an agreement in place prior to that date, that it was allowed to continue, but any new agreements, basically, they're not going to work in terms of reducing your threshold income because it's going to be disregarded. The big difference here is that you deduct personal contributions. So it doesn't include, adjusted income includes employer contributions, threshold doesn't, but also you can deduct personal contributions from your threshold income. The deduction at the end is the same as for adjusted. So as I've mentioned on the first slide, with the emojis on it, in terms of the tapered annual allowance, those clients that you have in that mid-range where their income is between the 110 and 150,000 bracket in the last 4 tax years, or for this year going forward, the 240,000 pound bracket, where you might be able to do some planning. You may be able to do with those people make personal pension contributions to bring their threshold income below the 110 or 200,000 as applicable, which takes them out of the taper. That's when you can do a bit more planning for them. And by doing that, taking them out of the taper with a personal contribution to just bring them below the taper may actually allow a higher level of employer contribution. That may be possible. Just a note on salary sacrifice. So obviously this is deducted for new salary sacrifice arrangements after the 8th of July 15 from your threshold income, that it does include any flexible remuneration arrangements. There's things like, if you reduce your income one year and then have a corresponding increase the following year, so you tapered one year but not the next, that would be disregarded. Anything saying to secure increased benefits for the individual, the dependents, or anybody connected with them. So you can't, husband and wife in a business can't decrease his salary and then increase hers correspondingly, or vice versa on that. So they were quite tight on the anti-avoidance and salary sacrifice, trying to close loopholes around tapered. Okay, so just going to have a look at the case study then of how this works in practice for somebody who is tapered. One of the main issues with a tapered is that income. People don't know what their income is till after the tax year has ended, especially when it includes all their investment income as well, not just earned income. And so it can be certainly well used and certainly can be advisable maybe to not, if you don't know exactly what your annual allowance is going to be in the year, that you will wait until after the tax year has ended and then mop up using carry forward to make sure that you don't have an annual allowance charge. So what I'm trying to do on this case study is just having a look really at, if your client wants to know in this scenario, they want to know what's the maximum contribution they can put in this tax year and get tax relief on it without having an annual allowance charge. So I've looked back at the figures. I've got the figures for the last few years. You will see from the unused allowance column on the right hand side there, I've got £10,000 in brackets in 2018-19, which means I've used carry forward in that year. So I know because he's exceeded the available annual allowance in that particular year, I've got to go back 3 years prior when I'm working out my carry forward. Hence I'm starting at 2015-16. Tapered annual allowance didn't exist in 15-16, so we don't have to worry about threshold and adjusted income. We don't have to work that out. We know the annual allowance was 40,000, so it's made contributions here of 30,000, 10,000 unused annual allowance, that's fine. 16-17, okay, we start worrying about the taper here. There were £20,000 over the adjusted income limit, therefore his annual allowance was reduced by £10,000 to 30,000. Actually made a 20,000 contribution, 10,000 unused allowance. We can see 17-18 with £30,000 over the adjusted income limit. Therefore, the annual allowance reduction was 15,000, so it took it from 40,000 down to 25,000. 20,000 contribution, 5,000 unused allowance. 2018-19, threshold income was only 105,000, so that actually means they weren't caught by the taper, so they had the full annual allowance available of £40,000, so they can make £50,000. So that's in this case, you can see this is, if the threshold income was 105 and adjusted income was 155, I can see that's going to be an employer contribution, because generally speaking, that's what's going to be the difference between threshold and adjusted. So he's got £50,000 contribution there. So he's used his 40,000 annual allowance for that tax year, and he's used 10,000 carry forward from earlier. Last year, adjusted income was 170,000. He was over the threshold, £20,000 over, 10,000 reduction in annual allowance down to 30,000. Only made contributions of 5,000, 25,000 of unused allowance. So the question is really, okay, well, how much can you put in this year? What do we think? So let's have a look through what's available. So I can see that the 10,000 carry forward that was used in 2018-19 actually stemmed from the 15-16, because they used the annual allowance in that year, and then you'd have used the oldest one first, which was 3 years prior to that, so that would have been used up then. which left in 2016-17, there was 10,000 unused allowance. Now, I could have used that in the 1920 tax year, but they didn't. And because that's more than 3 years old now, that's gone. There's nothing you can do about that one. That's not been used. That's lost. Well, what we have got here is 5,000 carry forward is available from 17-18, plus you've got 25,000 from last year. So there's £30,000 of carry forward available. Now, of course, what you don't know is what their income is going to be this year. To know what this year's annual allowance is, but obviously, it's only theoretical, but for a client who had those levels of income over the last 5 years, 4 years at least there, I should say, you can see that given the increases that we have to the threshold of adjusted income to £200,000 and £240,000, unless they've had a substantial increase in their income in the year, which this year of all years is probably quite unlikely, it's unlikely that they're going to be tapered under the new rules. So if you were confident of that, then you could actually make a £70,000 contribution, because you'd have 40,000 from this year and you've got 30,000 of carry forward available. In your worst case scenario, if you thought they were going to have a fantastic year and earn lots of money and they have maximum taper, but the worst case scenario would be that they would have 4,000 annual allowance this year and they could still use the 30,000 carry forward and make a contribution of 34,000. It may be, obviously, if you think they are going to be tapered, but maybe not to the full amount, that you do some calculations and work out, okay, realistically, and put a contribution in somewhere between those levels based on a level of confidence that you have of their earnings and the maximum taper they're realistically likely to have. Okay, moving on now to the money purchase annual allowance, the MPAA. So the MPAA is triggered when you take flexible benefits. So normally that will mean taking income from Flexi Access Drawdown, not taking just PCLS, that doesn't trigger it, it's just the income part of it from Flexi Access Drawdown. There is a little anomaly in that, is that if somebody has disqualifying pension credit rights, which would be from pension sharing on divorce, and if they take income from those funds, that doesn't trigger the MPAA. We will, as part of our off the road webinar series, we have got a divorce one planned. It might be in a few weeks' time, so I'll talk a few more about little quirks like that then. So triggering, yeah, normally for most people it's going to be taking any income under Flexi Access Drawdown, taking any UFPLS payment, or having a flexible annuity. They're the main trigger points. I have written a guide on the money purchase annual allowance, which goes into a lot more detail. Haven't got time to go through all the minor nitty-gritty bits of it today, but if you're signed up to watch this webinar rather than catching up with it on their website later on, you will get emailed out at the end when you get the slides in your CPD. You will also get that guide, a link to that guide, emailed out to you, and it will be available on the website later if you want to know more about it. So the MPAA then, so triggers when you flexibly take benefits, is £4,000. It only applies to money purchase pension schemes because the clue's in the name. Big point is that you can't use carry forward in relation to money purchase pension inputs once you've triggered the MPAA. You can still use carry forward in relation to the alternative annual allowance, which I'll come on to in a moment. MPAA is horrible in a lot of ways, but one of the big ones is the fact there's no going back on it. Once it's triggered, it is for life. Something that we are hoping may change given the current situation, and certainly something we've been lobbying for, at least a temporary relaxation that people need to access their pensions. People over 55 need to access their pensions maybe earlier than they would have planned because they're not being worked at the moment because of the pandemic, but they shouldn't be penalised in terms of being able to make future contributions if they return to work in the future. But as it stands, that is not the case. Once you trigger it, that's it, and obviously severely restricts your ability to rebuild pension pots afterwards. The other thing which isn't very nice about the MPAA is the information requirements. So what happens is when a member request benefits to their scheme administrators, they put that request in. And if it's a trigger event, obviously on the benefit crystallization event, when they, or it could be not even, it doesn't have to be a BCE because it could already be in drawdown. But when they first trying to take that first income payment, if it's flexi access drawdown, they're taking the first payment. When they trigger the MPAA, the scheme administrator then has to send them a statement within 31 days telling them that you have now flexibly accessed your benefits, tell them the date of the trigger, which would be the, if it's a UFBLS payment, it'll be the date of the payment made or the first income payment and the flexi access drawdown. Tell them that the 4,000 body purchase annual allowance applies. Tell them they will get an annual allowance charge if they exceed the MPAA. And also it tells the members that they then have to go on and tell the scheme administrators of any other pension schemes they are active members of. So the member then has a responsibility within 91 days of receiving that letter from the scheme administrator to send it to all the other schemes I say that they are active members of. So it does put quite a lot of emphasis on the member. Also, if the member then some point anytime later on after that event, they then join a new pension scheme, they then have, again, within 91 days of joining that scheme, they have to tell that scheme administrator, which might not be in the forefront of their mind, but they have to do that. And if they don't, there is potential for fines. Now, I'm not aware, I haven't heard of, about members, individual members being fined. But it's certainly in the regulations there is a possibility for both the scheme administrator being fined, but also the individual members if they don't pass that information on to other schemes. And it's a £300 penalty for failing to provide the information on time, and £60 for every day it remains outstanding after that. So, it could be quite nasty potentially. So certainly want to make sure that your clients are aware of and telling who they need to be telling once they do trigger the MPAA. So a bit more on the MPAA, we get asked about what happens in the year of trigger when you first start taking benefits. So in this example here, I've got somebody who's triggering the MPAA on the 1st of October 2020. They've already made £30,000 contribution in the period 6th of April to the 1st of October. So that's pre-trigger. Post-trigger, they can make another £4,000 contribution. The way that works against the annual allowances then is that the whole amount, 34,000, is measured against the annual allowance, and then just the 4,000 post-trigger is measured against the MPAA. So in that circumstances, it's fine. They've not exceeded either annual allowance. They don't have an annual allowance charge. So you're actually fine to load contributions into a pension scheme in the year, if your client is going to trigger the MPAA, as long as you do it before the date of the trigger. It's fine. This is what happens if you might exceed one of them. So again, put in £30,000 before they trigger the MPAA. They put £6,000 in after they have triggered it. You still have the same process. So the 36,000 is measured against the annual allowance. That's fine, no charge there. But the 6,000 is measured against the MPAA, at which point you would then have the charge on the excess of £2,000. Finally then, for types of allowances, we have the alternative annual allowance, to say probably the least known and talked about ones. It is quite a niche one. The alternative annual allowance is usually £36,000, but it only applies for defined benefit schemes and only when the member has triggered the MPAA and exceeded it. So somebody who's got a DB scheme and a money purchase scheme, they've started taking income under drawdown in their money purchase scheme, they've triggered the MPAA, but they still have benefit accrual going on in the DB scheme. And they've put in more than £4,000 into their money purchase scheme. Basically, what this means is that if you put £4,000, sorry, if you put, say, for example, you put £5,000 into your money purchase scheme, so you've got a £1,000 excess, so you're going to have an annual allowance charge of £1,000. It doesn't make any difference whether you put £35,000 or £36,000. have accrual into your DB scheme because you've exceeded it. You've exceeded the MPAA by £1,000. So actually, by only putting £35,000 into your DB scheme, so overall you've not exceeded the 40,000, doesn't actually help you at all, doesn't make any difference. You may as well put the 36,000 in because you're still going to have the £1,000 charge on the MPAA excess anyway. You can use carry forward still to increase the alternative annual allowance for the DB schemes. So we talk about when someone's triggered the MPAA, you can't use carry forward, and that is true in relation to the money purchase element, but it's not. They can still use carry forward in terms of the DB accrual if they have both. Somebody might have a lower alternative annual allowance now if they are tapered. That didn't used to be the case because the minimum on the taper used to be down to 10,000. Because the minimum taper is down to £4,000 now under the new rules, your really high earners, if they have, who only would have a 4,000 tapered annual allowance in total anyway. Obviously, if the MPAA is £4,000, that's the maximum under the taper. They wouldn't have an alternative annual allowance in those circumstances. Right, so that's all the annual allowances covered in the interactions. Now we're looking at what actually happens when somebody has exceeded them. Obviously, it does still happen even with the best intentions, and especially in relation to the taper. I think and the annual allowance charges have certainly increased significantly since the tapered annual allowance was introduced. So the annual allowance charge works by reducing the tax relief received on pension savings above the applicable annual allowance. So you actually, it's a bit funny, going back to the start, you get the tax relief on it, but then it claws it back. So it effectively reduces the tax relief received. The chargeable amount, so the amount above the annual allowance, is the chargeable amount. That is added to the taxable income for the year of the tax calculated accordingly. So I've got a couple of case studies here. The method of calculating the charge and how it's worked out is different depending on the type of scheme. You have the same result, it's the same net effect, but the process is different depending whether it's a relief at source scheme or whether it's a net pay scheme. So we're going to look at an example for relief at source first, then I'll look at a net pay example. So here we have Rebecca, who has a £100,000 salary. She has made a £20,000 personal contribution, and her employer has made a £30,000 contribution in the tax year. So she's not tapered, she doesn't earn enough to be tapered. She's not triggered the MPAA, so she has the standard 40,000 annual allowance, and I'm assuming here she doesn't have any carry forward available for these purposes. So if we look at the figures there, she has a £100,000 salary. She has a personal allowance. She has the full personal allowance because her earnings aren't enough to take her to the point where she starts losing that. So her taxable income for the year is now £87,500. You then add on the chargeable amount. So because her annual pension input amount for the year is the 20,000 and the 30,000 contributions is £50,000, the chargeable amount is the excess over available annual allowance of 40,000. So the chargeable amount is £10,000. So that is added on to her taxable income for the year, and then the income tax is applied to that amount. It's a bit bizarre in terminology for HMRC. The chargeable amount is not income for tax purposes, but it is a charge to income tax. It can't in itself cause a loss of a personal allowance, and it's not subject to an I. So we've got this 97,500 subject to income tax. So she still has the full basic rate band of 37,500, so she gets that at 20% tax. The way relief at source schemes, if you make a personal contribution to a relief at source scheme, you get an extension of the basic rate band by the amount of your contribution. That's how the relief works. If you want to know more about that, I did talk about it in more detail, let's say, in my pension contributions webinar, which is on the website. So that's another £20,000, so that's also at 20%. So that's effectively, she's had £57,500 at 20% tax, and then the balance of that will fall into the higher rate tax band, so 40,000 at 40%. So her tax payable for the year is 27,500. Now, just so you can sort of work out how much is the annual allowance charges, I'm going to imagine she didn't have an annual a chargeable amount, and look, do the calculations again. So she still had the basic rate band here of 37,500 as standard. Because she made a £20,000 personal contribution, she still gets that band extension. But the balance that's taxable at the higher rate, if she didn't have a chargeable amount, so for example, if she'd had carry forward available to cover it, she didn't have any chargeable amount, obviously the balance, which would be then chargeable at higher rate tax, would only be 30,000, not 40,000, because effectively she's got 10,000 less income to be taxed on. As the tax payable would have been £23,500. So the difference between those figures, those two figures, the 27,500, 23,500, it's £4,000, and that is the amount of the annual allowance charge. So that's effectively her charge, which is what you'd expect for a £10,000 chargeable amount, somebody who's a higher rate taxpayer of 40%. But that's how it's actually calculated. And obviously some people will be across different bands, so it won't be quite as straightforward, which I'll show you a little bit with now on the net pay example. So here I've got Joe, who earns £60,000 his salary before his net pay deduction. But he's triggered the MPAA, so his annual allowance for money purchase schemes is only £4,000, but he's paid £15,000 net pay contribution into a money purchase scheme. So here, he's got his £60,000 salary, deduct his net pay contribution and his personal allowance. His taxable income for the year is only £32,500. Chargeable amount will be 11,000 because he's got a 4,000 MPAA. So the excess, the chargeable amount is 11,000. Add that to his total amount subject to income tax for the year, gives him 43,500. So he has the basic rate band. So his first £37,500, sorry, is taxed at 20%. And the balance of his income is taxed at £6,000, sorry, is taxed at 40%. Because it's a net pay, you don't have the band extension like you do under the relief at source scheme. So it's more straightforward calculation. So his tax payable for the year there is 9,900. If we compare that, if he didn't have the chargeable amount, then all of his income, 32,500, would have been within the basic rate band. So it would have been 6,500. So in his case, the difference between those two figures of 3,400, that is the amount of the annual allowance charge. Which, if you look at it, if he's got an £11,000 excess on a salary of 60,000, he has 5,000. Effectively, he has 5,000, which is charged at 20%, and 6,000 charged at 40%, which is that gives you a £3,400 difference. Okay, finally, looking at paying the charge then. This information sheet, I'm sure a lot of you will be familiar with it, but if you're not, all things about paying tax charges and self-assessment, type in HS345 into Google, it'll bring up the worksheet. On here, on the side here, you'll see this annual allowance calculator tools, things like that. If you're doing lifetime allowance, this is on the same page as well. Basically, when it comes to paying the charge, you have to report it on the self-assessment and say this is the help sheet that sort of tells you how to complete those boxes on the pension savings tax charges section. This gives you all the information, the tools, the details of how to do it. It also talks about things like if you don't know the amount of the charge because you're estimating, that's okay, that's acceptable from HMRC. You have to tell them, and how you tell them that it's an estimate and that you've got 12 months to go of the statutory filing date. You can go back and amend the return as appropriate. Really important that personal contributions for higher rate taxpayers, additional rate taxpayers, obviously all the figures I've looked at today have been for for England, Northern Ireland and Wales, not Scotland, so apologies for those of you north of the border or clients north of the border. Obviously the principles are the same, but the tax figures will be slightly different. Really important for those people who aren't just paying 20% tax, that they put their pension contributions on their self-assessment so they get the additional tax relief. Even if they're paying an annual allowance charge, you need to make sure you're getting that extra tax relief, and then annual allowance charge cancels it out. Otherwise, you end up with an annual allowance charge, but you've not even got the tax relief in the first place. So please make sure you do that and your clients do that. So that's sort of how you report the charge to HMRC, and obviously the member can pay it personally. That's fine. But there is the option of using scheme pays potentially. So pension scheme can pay it. There's different types, 2 different types of scheme pays. We have what the regulations just call scheme pays, or we'll say compulsory scheme pays. We also have voluntary scheme pays. Very strict rules on scheme pays. Scheme pays, first of all, the AA must have been exceeded in the scheme. By that we mean the standard annual allowance. So you can only use compulsory scheme pays if the £40,000 annual allowance has been exceeded in the scheme that you want to pay the charge, and that charge must be more than £2,000. There are deadlines where you have to notify the scheme. So if it was for the 1920 tax year, you have to do your self-assessment by January 21. You have to tell the scheme by July 21. That is the deadline. Apart from if you've got NHS members, because they've just announced an extension for NHS pension scheme. They've got an extension till October this year rather than July, but that's just a one-off current circumstances. Any other schemes, it's still going to be July. If you meet those conditions and you notify the scheme in time and you meet the conditions of the 40,000 being exceeded, then the scheme has to pay it and they have joint liability with the member. So, okay, that's one circumstances, but it's quite limited. Obviously, a lot of what we see, it's not about people exceeding the 40,000. It's much more common that somebody's exceeded the tapered annual allowance, and you can't use compulsory scheme pays. I say if it's just the taper that's been exceeded, or the MPAA for that matter. So voluntary scheme pays is much more flexible because any charge can be paid, doesn't matter how much it is, which annual allowance has been exceeded. There's no specific deadlines in the regulations for voluntary scheme pays, but it is due because the member has the liability and the member retains the liability. The scheme is never liable under voluntary scheme pays. That you do have to pay. If you don't pay it by the self-assessment deadline, then there could be fines for late payment. Since it says voluntary scheme pays, the scheme doesn't have to do it. They can do it if they want to. A lot of schemes are doing it now, but not everybody. So you need to ask the scheme concerned. It may be that some schemes will allow you to pay the charge from their scheme, even if the charge has arisen because of contributions to a different scheme. That's certainly the case. If we have evidence of contributions going into other schemes, but somebody has got a SIP with us, then they can, as long as we get that evidence, you can still pay voluntary scheme pays charge from one of our SIPs, even if it's it's due to DB accrual, maybe somewhere else. We can facilitate that. So in terms of deadlines, then I say there isn't any fixed deadline for voluntary scheme pays, but to say there is this chance of having a late payment charge, interest charge, if you don't meet the self-assessment deadline of 31st of January. But the way that schemes account, the way that pension schemes have to pay it over to HMRC, it's via their accounting for tax return, which is a quarterly return. And for you to guarantee that the pension scheme, if they've agreed to pay it, that it is with HMRC by 31st of January. If you look at the dates there, you'll see the only way the latest you have to get that in would actually be the 30th of September for them to account for it in that period. So that goes into that quarter's return, the July to September return, to guarantee HMRC have it by the 14th of November. If you did it in the October to December period, it might be that the scheme pays it to HMRC by the 31st of January, but obviously they don't have to. It's not guaranteed. So if you want to be sure of it, then you need to really get it in the July, September, and obviously don't send it to your administrator on the 30th of September and expect them to do it and get it all processed on one day. So yeah, just to be aware of those deadlines, because it does make it quite a lot earlier. Doesn't mean you can't still use voluntary scheme pays after those deadlines, because there are no official deadlines. It just means there is a risk that there may be this late payment interest, which the member could be charged for. Doesn't necessarily mean they will, but just to be aware of that. Right, I think I've probably talked for long enough, so I'm just going to finish off now with the key points just to summarise. So, yeah, annual allowance then. The availability of the annual allowance does not impact how tax relief is claimed. It is quite confusing in the interaction between the two, but the actual process for claiming tax relief, the annual allowance is irrelevant, but obviously you do have corresponding charges if you exceed the annual allowance. Carried forward is always the allowance that's carried forward, not tax relief. Tapered annual allowance is still horribly complex. They haven't changed that at all, but it will affect fewer people in the future. Money purchase annual allowance, you have to be very careful with that, obviously, because it is an irreversible decision. And don't forget the information requirements, because the potential for fines and things there are quite horrible. And then finally, annual allowance charges may be able to be paid from the scheme. And with voluntary scheme pay, as I say, some schemes will let you pay it even if it doesn't relate to that particular scheme. Whether if you want to go down the scheme pays route rather than the member pay it personally. Right, so that is all from me for today. So thank you very much for listening. So if you do have any questions, do let us know, either by the question function here, if that's closing. We will email around sort of the slides CPD. You can always ask some follow-up questions from that if needs be. And I look forward to talking to you next time on the next subject in our series. So keep safe, everybody. Thank you very much.